Silvergate, Silicon Valley Bank, and Signature Bank have been liquidated in one of the worst weeks for the U.S. banking sector in recent years, forcing the Treasury Department and the Federal Reserve to intervene to send a message of calm to the markets, but only partially solving what could be the tip of the iceberg of a problem that goes far beyond these regional banks. On March 8, Silvergate, a California bank that had cryptocurrency exchanges as its main clients, decided to undergo voluntary liquidation, thus ending more than 3 decades of history. And what until then seemed like an exclusive problem of the cryptocurrency world quickly changed, and economic headlines began to be filled with the story of Silicon Valley Bank, another bank that would be forced to liquidate its operations, which became the second largest bank failure in U.S. history. A bank that, as its name suggests, was heavily tied to Silicon Valley's innovation ecosystem, putting the deposits of science and technology companies at risk. By that point, it became very clear that this was not a problem of a single bank caused by an isolated event in the cryptocurrency world, but rather a problem of the entire sector, and one that had a strong contagion risk. And to this list would be added Signature Bank, while dozens of regional banks like First Republic Bank, Western Alliance Bancorp, KeyCorp, among many others, suffered massive losses on the stock market. What's going on? Although in theory, these 3 banks are not connected, and the fall of each one was not due to the other 2, all these banks, and in fact, all the regional banks in the United States, and to a lesser extent the large ones, have a liquidity problem associated with their investments that makes them extremely vulnerable. These banks have long-term U.S. Treasury bonds investments, which, as they have been bought in recent years, have a reduced market value due to rising interest rates. When rates rise, bonds lose value, and when rates fall, they gain value. In fact, the Federal Deposit Insurance Corporation estimates that if U.S. banks liquidated their securities at this time, they would incur losses of around $600 billion, enough to wipe out most of the sector. But it is important to clarify that banks would only incur these losses if they were forced to liquidate these positions, which is something that generally has little chance of happening for several reasons, such as the fact that bank runs have become excessively unusual, the high liquidity of recent years, more sophisticated risk and liquidity management practices, among other reasons. But since the current context is anything but normal, then just as distrust caused money to leave cryptocurrency exchanges, and they in turn withdrew the deposits they had in Silvergate, forcing it to liquidate a large part of its positions, the same way, many banks in the United States are currently in a situation where they are extremely vulnerable to the massive withdrawal of deposits by their clients. And many banks, especially smaller ones, are not well prepared to withstand a wave of distrust in the sector because their reserves have fallen sharply and are currently near the lows of recent years, but in a context where they cannot increase them as easily as before. What is the government doing? In order to reassure the market, the Department of the Treasury, the Federal Reserve, and the Federal Deposit Insurance Corporation have committed to backing the deposits of banks beyond the insurance limit of $250,000. Essentially, they will liquidate the assets of these banks to respond to depositors, while shareholders and creditors will not receive anything. If the money is not enough to respond to the depositors, a one-time tax will be implemented on the rest of the system to cover the difference. These measures are not approved by everyone and reopen an eternal debate about whether or not to rescue institutions at risk of contagion and whether the cost of doing so is greater or lesser than a crisis, but that is a long and complex issue for which we would need another video. For now, although it is a very changing situation, banks such as First Republic Bank, Western Alliance Bancorp, and KeyCorp have responded favorably, and on March 14th, they had positive variations of 27%, 14%, and 18%, respectively. But as you can imagine, this is far from over, and there is something happening in the background that connects this with the massive layoffs in the technology sector, market downturns, the crypto winter, the consumer crisis in the United States, among other events. At the risk of sounding repetitive, we are facing the end of an era. After 14 years of high money creation and low inflation, the economic context has changed and demographic factors, deglobalization, wars, among others, have caused persistent inflation, which will require higher rates from now on, accepting higher inflation than 2% or a combination of both. And when inflation began to resurface in 2021, it became clear that a crisis could come from the increase in interest rates to combat it. And although at this moment it is manifesting itself as a problem in banks, where the reduction in liquidity in the system is reducing their room for maneuver to respond to depositors requesting their money, this has not been the only problem facing the economy. With a large part of technology company layoffs related to projects that are no longer profitable in the face of rising interest rates, with the stock market falling now that more money is going to fixed income, which offers more attractive returns at low risk, a crisis of the U.S. consumer, where savings are at minimum levels and credit card debt is at maximum levels, among others. And all of them being related to a massive extinction of companies and projects that, although they could survive in an environment of abundant capital, low interest rates, low inflation, and high consumption capacity, can no longer do so in the new context. Although today it is regional banks with liquidity problems, tomorrow it could be companies in any sector, in a sudden and radical change that, while in the long term will be for the better because it will allow for creative destruction where talent and capital will go to the best projects and companies, in the short term, it can be very chaotic. Now, a couple of clarifications regarding everything that is happening. The first clarification is that even if the banking problem is completely forgotten in a couple of weeks, it is far from over and is just the tip of the iceberg of this change in the economic context. The second clarification is that although this video has focused on the particular situation in the United States, it is not exclusive to our country, and many others, with still high but decelerating inflation, face problems related to high interest rates where many businesses and projects are not longer viable, and where consumers have less incentive to consume because they can obtain good returns by saving, and have disincentives to spend because interest rates are, especially on credit cards, excessively high. The third clarification, which is worth mentioning, is that short-selling transactions are not guaranteed and carry high risk. In the case of banks in particular, because the problem originates from lack of confidence, which if it disappears would allow them to continue their operations normally. This could happen either because the public simply moves on, because the measures of the Fed and the Treasury Department give confidence to the public, or because the bank is rescued by an investor with liquidity who takes advantage of the panic to make a highly profitable investment. I hope this information has been useful to you. If it has, you may want to watch this video too. Remember to subscribe if you haven't already. See you next time.